Welcome to Oraculum Accounting YouTube channel. In this session, we will understand the complete transaction journey from the very first communication between two parties to final tax filing and profit recognition. Accounting is not about memorizing journal entries. It is about understanding how real business activities are converted into structured financial records. Every transaction follows a logical path. When you understand that path, accounting becomes systematic and predictable rather than mechanical and confusing. Let us begin with the sales transaction journey. Every sale starts with initial communication. A potential customer approaches the business with a requirement. This requirement may relate to a product or a service. At this stage, the seller listens carefully to understand quantity, specifications, pricing expectations, delivery timeline, and customization needs. Nothing is legally binding at this stage. The objective is clarity and alignment. This stage is important because it prevents misunderstandings. It ensures both parties understand expectations before any commitment is made. It lays the foundation for pricing and documentation. After clarity is achieved, the seller prepares a quotation. A quotation converts informal discussion into structured commercial terms. It clearly outlines product or service description, quantity, unit price, total value, applicable tax, payment terms, and delivery conditions. The quotation represents intent, but not obligation. It creates transparency and protects both parties from ambiguity. It becomes a reference point for future documents. If the customer agrees to the quotation, they issue a purchase order, commonly known as a PO. The purchase order is the customer's official confirmation to proceed. It indicates internal approval and financial authorization. At this point, the transaction moves from negotiation to commitment. The PO gives the seller confidence to execute the order. It reduces cancellation risk and acts as legal evidence of agreement. Once the PO is received, the seller generates an invoice. The invoice is a formal billing document that creates payment obligation. It includes invoice number, invoice date, customer details, quantity supplied, unit price, tax breakup, and total payable amount. From an accounting perspective, this is the moment revenue is recorded. A receivable is created in the books. Tax liability is also recorded separately. The invoice transforms agreement into financial obligation. After invoicing, dispatch and delivery occur. Goods are physically moved to the customer, or services are formally delivered. Delivery confirms that the seller has fulfilled the commitment made in the quotation and confirmed in the purchase order. Without dispatch or delivery, the transaction is incomplete operationally. Delivery documents provide evidence in case of disputes. Following delivery, the customer makes payment according to agreed terms. Payment may be immediate or after a credit period. When payment is received, the receivable converts into cash. This improves liquidity and strengthens working capital. However, payment confirmation is not assumed. The seller must verify bank receipt. Funds must be actually credited in the bank account. Accounting records must reflect real cash movement, not verbal confirmation. After bank confirmation, remittance advice may be issued. This confirms which invoice has been settled. When multiple invoices exist, this step prevents confusion and ensures synchronized records. Next comes reconciliation. Reconciliation means matching the invoice, customer ledger, and bank statement. Any discrepancy is identified and corrected. This strengthens financial accuracy and maintains a clean audit trail. After reconciliation, output tax recognition is finalized. The tax portion collected on sales does not belong to the business. It is collected on behalf of the government. Therefore, it must be recorded as a liability and separated from revenue. Treating tax as income would overstate profit and create compliance risk. Once tax is separated, profit and loss recognition takes place. Revenue and related cost of goods sold are recorded in the profit and loss account. This measures actual financial performance. It determines profitability and supports decision-making. Finally, tax filing and payment complete the sales journey. Sales data and tax liability are reported in statutory returns. After adjusting eligible credits, tax is paid to the government. This ensures compliance and closes the reporting cycle. Now, let us move to the purchase transaction journey. The purchase cycle begins with requirement identification. A department recognizes the need for goods or services. This may arise from operational necessity, production demand, or inventory replenishment. Planning ensures spending is controlled and justified. Next, supplier quotations are obtained. Suppliers provide pricing details, tax information, and delivery terms. This enables cost comparison and informed decision-making. Once a supplier is selected, the business issues a purchase order. This formalizes commitment and authorizes the supplier to deliver goods. It also confirms internal spending approval. After supply, the supplier sends an invoice. This invoice creates a liability in the buyer's books. A payable is recorded. The business now owes money to the supplier. The business now owes money to the supplier. The business then makes payment within the agreed credit period. Payment represents cash outflow and clears the recorded liability. It directly affects liquidity and working capital. Upon receiving goods, verification is conducted. Quantity, quality, and pricing are checked against the purchase order and invoice. This operational control prevents overpayment and fraud. After payment, balance confirmation ensures that the supplier's ledger shows no outstanding amount. This confirms proper closure of liability. Bank reconciliation follows. The recorded payment is matched with the bank statement to ensure funds were actually transferred. This maintains financial integrity and prevents discrepancies. Next comes expense recognition. The purchase value, excluding tax, is recorded either as an expense or inventory, depending on its nature. Accurate classification ensures proper profit measurement. Input tax credit is then recorded separately. Tax paid on purchases, if eligible, can be adjusted against output tax liability. Separating tax prevents overstating business costs and improves tax efficiency. Finally, tax filing completes the purchase cycle. Purchases and input tax credit are reported in statutory returns. The eligible credit is adjusted against output tax to determine net tax payable. In conclusion, the transaction journey demonstrates that accounting is the structured recording of real business events. Every sale and every purchase follows a logical sequence from communication to documentation, from financial recognition to bank movement, from reconciliation to tax compliance. Accounting begins with business activity, not journal entries. Journal entries simply reflect decisions that have already occurred in operations. When you understand this structured flow, accounting becomes logical, clear, and manageable. This foundation strengthens financial reporting, compliance, internal control, and profitability analysis. For more structured accounting concepts and practical explanations, subscribe to Oraculum Accounting YouTube channel.